Hi everyone, welcome again to another financial analysis video with myself, Moed Amin, and my colleague, Ted Wainman. Today, we're going to be looking at a very well-known UK company called Marks and Spencer. It is a retail establishment. It's been around since 1884. And essentially, in retail, they provide, they're kind of almost like a department store in some ways. They provide food, clothing, furniture, things like that, most of which is their own brand, although I've noticed they've started to branch out, but don't quote me on that. And just some interesting facts about this business. So they have about as of 2020, they had 1,037 stores in the UK, with another 472 in about 29 countries around the world. So it's a fairly sizable retail business. And they have about 70,000 employees. Now, interesting point about them, because Christmas is obviously a big time of the year for retailers. According to researchers, when they looked at Google data, they found that Marks and Spencer's seem to be the more popular for Christmas food. And they are known for the quality of their food here in the UK, especially. So interesting to see that dynamic for the Christmas shopping. We're going to talk about the share price and the valuation of business. So stick around for that. They IPO'd in 1988. And as you can expect, from 1988, till now, they're going to go through some ups and downs. But the last year especially has shown some interesting moves. So stick around to see that. And of course, like, share, subscribe as always. So Ted, let's go into their finances and share with our viewers what we found.
Absolutely. So very good to see you again, Moed. How are you? And welcome to all our viewers. So yes, we are going to look at Marks and Spencer's financial statements. And I'm pleased to say that these are very, very recent at the time of this recording. So while it is still backward looking, they are reasonably up to date. So, but you're still welcome. We still get some comments from people saying this is a very backward-looking analysis. Well, it is. We're looking at the financial statements. So, as Moed mentioned, do remember to like, share, subscribe to the channel. Share with your colleagues and others who you think might find this useful. This is not just for investment analysts or people who are looking to potentially buy shares. This is for anybody who's looking to understand and improve their ability to read a set of financial statements. So whether you are a potential supplier with Marks and Spencer's, whether you are going to be selling to them, whether you just want to improve your own financial knowledge, your financial fluency effectively, then these videos are for you. Right, there's our plug. Let's jump in. You're much more interested in looking at the accounts. So here we have a fairly hefty tome of M&S accounts, 2021, running to 216 pages. So that's quite a lot of pages, and we have limited time, so we're not going to go through all of it. We are going to whiz through all of the kind of corporate governance and all this kind of stuff that you find at the beginning. And we're going to end up on page 125, where we find the income statement. Now, very interesting about the income statement. First of all, we notice top line, we notice the revenue. The revenue has fallen about 10%. So year on year, the revenue has come down. Now, you'll notice that the last year end was the 28th of March. That's basically when the pandemic kicked off and the shutdown happened. So, I'm kind of guessing that, people couldn't go out shopping, stores were closed. They do have their online, but, they'd have suffered from the pandemic. So that will be coming through there. Now, what's also very interesting about this set of accounts is it then jumps and tells us the operating loss. And it's kind of like, well, hold on a sec. When I've done my analysis, there's usually like cost of sales and the overheads, and there's none of that, which I think is rather interesting. And they've buried it in note number 3. So for some reason, M&S have decided they don't want you to kind of see the detail on the face of it. You've got to go and have a look at note number 3. Well, we are lazy, but we are not that lazy, which means that we will go and have a look at note number 3. And if I just whiz down to it, here it is. And note number 3 gives us that little bit of detail that we are looking for. So here's our analysis now. Here's the top line. The sales dropped by 10%. Here's the cost of sales. Cost of sales have also fallen, and the gross profit margin has slightly fallen. So it was 34% last year. It's now 32% this year. Now, that's quite low. So we did Gymshark a while ago. You may remember Moeed and Gymshark were hitting like 70% gross margin. And we'd expect them to be hitting similar kind of gross margin in their apparel, in the clothing department, but then the food is much tighter. It's much more competitive, and that will bring that margin down. And that's why we're seeing a 32% gross margin. That means for every pound that you spend at M&S, it costs them about 70p to buy the thing that you're buying, and they make 30p on it. Much higher margin in the clothing, much lower margin in the food, which is why they like both of them, because it gives them that kind of balance, that kind of diversification, so to speak. Here are the SG&A, the selling, general and administrative expenses. I'd expect there's quite a lot of furlough coming back in there, but they've kind of they've dropped their overheads a little bit. And interesting enough, also they have shares in Ocado. Now Ocado is online delivery. And online delivery would have sort of taken off, and therefore there's a profit in there, and these guys are taking a share of that profit. However, you will notice, however we cut the numbers, they book a loss in the year, an operating loss, 255 million pound profit in the prior year, down to a 31 million pound loss in the current year. And again, I think we will be laying the reason for that loss at the foot of COVID. So there is our 30 million. That's how we arrive at this 30 million operating loss. A little bit of financial income. There's financial costs, which means that they have debt sitting on their balance sheet, and we'll be able to see that a little bit later on. Overall loss for the year, 200 million pounds, down from a very small profit in the previous year of 30 million pounds. So these guys, basically running at break even in the previous year. They were turning over 10,000 million. That's 10 billion pounds. They're turning over 10 billion pounds and making a 30 million pound profit. That's basically zero. That's effectively break even. At least it's a positive break even. Here they're making a loss of 200 million. And so the trading statements are, what's happening post-COVID. People are back in the shops. Christmas just around the corner, as you say, and hopefully there's a kind of, a ray of sunshine on the horizon. So there's the profit and loss account, not looking too great. Let's go and have a look at their balance sheet. So things to notice in their balance sheet. So the non-current assets, this is the stuff that they need to run the business. And the biggest number there, property, plant and equipment. Quite interesting that property, plant and equipment being so high suggests that they own a lot of their stores. Now, I don't know whether that is the case. We could probably find out by looking in note 15. So here's their here is note 15, which gives us the equipment, and we're really interested in the kind of the net book value at the end of the year. That's this number here. And we see that most of it is sitting in these two columns here. And we can see those two columns. If we just scroll up a little bit, we can see that that is land and buildings, fixtures and fittings. So the answer is yes, they own a lot of their buildings. They'll build these sort of custom stores. They own them. They own the land, sometimes the land which is undeveloped. And then they've got a lot of fixtures and fittings actually sitting in those stores. That's all the stuff that kind of, it hangs off and the kind of, making the stores look nice and pretty. So lots of fixtures and fittings and fixed assets are in there. And then the current assets, three big things in the current assets, as we would expect: the inventory, the trade and other receivable. That's quite interesting, trade and other receivables. And then a lot of cash as well. So these guys have got a reasonable amount of cash, which is good. And they're going to need that cash, or that kind of helps them to weather any storm effectively. A little bit interesting about this trade and other receivables. You kind of think, well, within a supermarket, who owes them money? Because, certainly whenever I've tried to walk out of out of there and just sort of say, oh, add it to my account. They go, no, you pay before you leave the store. But actually, if we actually look into the note, and we're not going to do that, but if you did look at note 17, you would see that there's very little in terms of trade receivables. Most of it is just other people who owe them money, other receivables. And in fact, their debtor turnover days is only 5 days, which means on average they get paid within 5 days, which is almost how long it takes to clear through the credit card system. Their stock turnover is 35 days. It's not looking too bad. So if you add those two together, it says that from the day they buy something to the day they get the cash in is about 40 days. Very back of an envelope calculation, but that does not look unreasonable for a company like this. 35-day stock turnover. Don't forget milk. It's going to go a little bit quicker. And hopefully those summer dresses don't hang around for too long, at least not until the winter. And some of the tinned food may take a little bit longer to shift. Looking at the liability, so 8.6 billion of assets, a little bit down from the previous year, not a lot of investment. So we'll see that the fixed assets have come down. That's mainly because they have been depreciating those assets without the investment. They haven't been investing because the stores have been closed. On the liability side, the big liabilities, so the current liabilities, the big liabilities are the trade payables, 1.6 billion. Now, I can see you, Moe, thinking, oh, hold on a sec, Ted. Just scroll up a little bit. Let me have a look at those current assets again. And you're right. If you were to compare the current assets, even with the current liabilities, you would say, hold on a sec. Aren't these guys going to struggle to pay their liabilities? Even if you just compare it to the suppliers, isn't that an issue? And the answer is no. And the reason that M&S can operate with this, what we call a liquidity ratio of below 1, is because their business model, they pay their suppliers 60 days. In fact, it's almost exactly on 60 days, which is directly within the rule of EU Directive 0711, which says that thou shalt pay thy suppliers within 60 days. So M&S very sensibly say to their suppliers, we'll pay you in 60 days. So they're getting the money in on day 40, paying it out on day 60, which means they've got good, strong, positive cash flow and allows them to operate at a liquidity ratio of below 1. And then just looking at the bottom half of the balance sheet, here we can see there's all the debt sitting on their balance sheet. So quite a lot of debt, but then the equity, so the total liabilities is 6.3 billion. Of that, the non-current liabilities is 4 billion. Of that, 3.7 is debt, compared with the equity of about 2.3 billion. So a little bit more debt than equity, probably a little bit more debt than I would like to see. But and again, there's an operating loss, so they're certainly not showing a clear interest cover. Just go back to the profit and loss account to tell you what I mean by that. So when we look at debt, what we're doing is we're comparing what are your interest costs versus how much profit you're making. So you'll see in the previous year, which is kind of normal, they were just about making enough profit to pay their interest. Means there's not a lot left over for the shareholders. Okay, that's kind of where we're reading in here. And of course, we're talking today about inflation taking off, and therefore interest rates will rise. Now, you may say Marks and Spencers, they'll be able to transfer any inflationary costs onto their customers. So this number here would expect to go up in an inflationary environment. But then, of course, their inputs are going to go up as well. So we're not going to see a massive increase in their profit figure. But if interest rates go up, we will see the interest go up, and therefore the interest cover will start to fall. M&S, by the way, is not the only company that is going to start to face scary times with that. So do watch those companies with stuffed full of debt, and make sure that you're comfortable on their interest cover and they can survive interest rate increases, because they're only going in one direction right now. So there is our balance sheet. Not a lot else to say about the balance sheet. And in terms of the equity, there's quite a few funny little bits and pieces. This kind of big other reserve stuffed in there, but at the end of the day, they've been making profits, and they have a reasonable amount of capital, of equity in there. They paid out dividends last year. here they are. We'll just highlight them. 191 million. So if you're a shareholder in M&S, and I know that there are lots and lots, certainly there used to be back in the day, lots of small shareholders who used to sort of pop along to the AGM for their cup of tea and a biscuit. So they've got a nice little dividend, but no dividends this year for obvious reasons. Booking a loss, pandemics all over the place, a little bit of a mess, and they're just really thinking, you know what, we don't want to be doing that. And also there is some stuff bouncing around in here. You'll notice here it says remeasurements of retirement benefit schemes. Always get a little bit nervous about that. That has a negative effect. That's reducing the capital. That's their their pension deficit. So that's a movement on the pension deficit, and obviously the pension itself is very separate, but if there's any shortfall, then the company has to make it up. So that could become a millstone around their neck, not sitting on their balance sheet as a liability, but is a potential issue. Here's their cash flow operation, or their cash flow statement, cash flow. So as we'd expect from a company like this, nice big strong cash flows. I mentioned that because of their business model. They get paid by their customers, you and me, before they pay their suppliers. So always expect to see that. CapEx is much lower, and I think that the reason for that is that they, you'll see that, here they did a big purchase in the previous year. I'm guessing that's Ocado. And this year, CapEx has come down, and we'd expect that because the stores were closed. People weren't in actually, doing the refits, etc., etc. So that's a kind of a pandemic thing. We'd expect to see that coming back later on this year. Cash flows from financing activities, little bit of so here's the interest that's being paid. So there's a substantial amount of interest being paid, and if we take these numbers together, there's a bit of refinancing going on, and you'll notice kind of long-term, short-term debt is bouncing around a little bit, and repaying the liabilities. Payments of the liabilities to the UK pension schemes. So you can actually see, there is some physical payments going into the pension scheme. So they're kind of keeping that one propped up. Hopefully they're not going to do I think it was a BHS who stripped the company and left the pension holders high and dry. So that's the business. That's effectively it. I don't think there's anything really more to say about their financial statements. There's no kind of real gremlins in there. There's, as I said, there is some of this sort of funny stuff. That's anything which says other reserve, and they decide to put 6.5 billion. You kind of scratch your head and think, what's going on there? The pension scheme, the liability for the pension scheme is sitting on the balance sheet, but it's not massive. They've got some derivatives. You'll notice this will be protecting their interest payments on their debt, I would expect. There may be some foreign exchange contracts in there. They do have overseas operations, so they may be kind of hedging forex exposure there, but I'd expect that to be mainly interest rate swaps. So let's go and have a look at their share price. And I have to admit, full disclosure, I once was an investor in M&S many years ago. In fact, I'm actually looking at this chart and I'm trying to think when I sold out. And I think I sold out somewhere. All I remember is it was £4.20. So I think I sold out about here. Feeling quite pleased with myself as we sold out and watched the share price fall all the way down, and then slightly kind of kicking myself. It was coming back again, but it never really got, so I felt vindicated as it crumpled, and then it went sideways. And then look what happened. So late 2000 and sort of the early 2000s, I say late the early 2000s, so 2006-7, it flew up, okay, and kind of hit its big nadir before then this is the global financial crisis. So I'm not sure why M&S would have suffered quite so badly in the global financial crisis. And then since the kind of, hitting that bottom point, it's been making kind of, progress up. And then in 2000 and whatever that is, 14, it's been making pretty substantial progress down. So if you're a long-term holder, you kind of, if you're there for your tea and biscuits at the AGM, you've seen a roller coaster ride. You've made and lost fortunes more quickly than I don't know, Richard Branson. So it's it's been quite a rocky old ride, but anyway, kind of looking that far back doesn't really tell us much about this business, just that it's it's been a familiar name on the British high street. It's kind of a bit of a bellwether. It's kind of everybody talks about M&S results. It's kind of it used to be kind of almost part of everybody's portfolio, because they felt that when they went to buy their underwear, they went to M&S, bought their underwear, and they felt they were kind of doing themselves a favor. Anyway, let's move on to this year, and here we go. It's rising, and it has been rising since the beginning of this year. Now, it's quite interesting. It's on a market cap of 4.6 billion. Okay, so just to put that into context, the balance sheet is about 2.3 billion. So you're basically paying twice book value. Now, I don't know whether that's good or bad. It sounds, it doesn't sound massively cheap. The P ratio, quite interesting, 183 times. Now, the P ratio, that doesn't really make sense, because they made a loss, as we saw. However, if you compare the market cap to the profit they produced last year of 27 million, then you get to about 183. So it looks to me like that P ratio is based on the 2020 earnings result, not on the 2021, but that's just me having a guess. So it is loss making, so times earnings doesn't really make any there's no indication there. Market cap 4.6 billion. You know what I mean? Who knows? I mean, it's the fashion, the world of fashion is so fickle that M&S. I mean, I don't really shop there. I buy my pants. If you're an American, that's underwear for you. So I buy my underwear, buy my socks from them, because it's just kind of just solid stuff. And occasionally I go in for food, but I don't. If I buy food, if I want nice food, I go to Waitrose. If I do in the basic shop, I go to Lidl. If I want. I mean, I don't buy my clothes from there, so it's nothing that really appeals to me. But it's not for everybody. So the market cap 4.6 billion, P ratio 183 million. Market cap, is it worth it? Is that really? It doesn't look a steal to me. It doesn't look a bargain. It's not kind of a screaming buy. Remember, we recently looked at Lloyd's Banking Group, which was almost crazy in terms of its low valuation. M&S is not crazy in terms of its low valuation. I don't really get fashion. It's too fickle for me. It's not one for me, Moe. But hey, maybe you've got a better idea than I have.
I mean, I would agree with that for me personally, but if you're a fashion expert, you might have a very different opinion. So that was very interesting, Ted. Thank you for that. Like I always say to all of our viewers, if there is a company that you would like us to analyze for you, do leave a note in the comment section and we will get round to that, or hopefully get round to that. We're getting a flood of these requests. Like, share, subscribe as usual. But if you are an expert in the fashion industry, the retail industry, consumer goods, consumer market, we'd love to hear your thoughts. This is a community at the end of the day, and we're all in this to help each other. So do leave your thoughts and expertise and opinions in the comment section as well. Of course, do be polite with your comments. So until the next video, thank you, Ted. Thank you, everyone. We'll see you on the next show, on the next video.
Good to speak to you, Moe. See you later.